Welcome to the Market Huddle Plus, episode 27. I'm Patrick Ceresna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome Bloomberg macro strategist Simon White. We chat about the end of the central bank independence, inflation reacceleration, and the stock market momentum and more. So let's get Simon on the call. Now, Simon, great to have you on the show.
Yeah, thanks for having me.
All right. You brought a great slide deck, and I'm looking forward to jumping into it. But before we get into it, we are recording this 24 hours before the FOMC meeting and press conference, as well as a huge wave of Mag 7 earnings are going to be released. How are you sizing up the markets going into this event risk?
Well, I think it's really interesting. I think this collision you've got essentially of the Fed meeting tomorrow on Wednesday, and the Treasury refunding announcement. They did the initial part of the announcement on Monday, but they're going to actually tell you how they're going to, achieve that by the auction sizes. And this is kind of really gets to the heart, I think, of what's happening right now. Like we'll touch upon these things in more detail, but we're in, as far as I'm concerned, an elevated inflation regime, and that's really just changed absolutely everything. And one of the things it has changed de facto is central bank independence is really, in terms of modern day central bank independence that markets got used to over the last, 20 years or so is really a thing of the past. So looking at that this week, I think we've got the Treasury announcement and the Fed announcement. The market, as far as the Fed's concerned, we're not really expecting much of a change. Like they're not going to raise rates, they're not going to cut rates. But people are going to be looking for clues about what they're going to do about their balance sheet tightening. And again, that's going to be really, connected to what the Treasury decides as well, because of this crossover between Treasury, fiscal and monetary, you're going to see a lot of a kind of overlap between the two. And I think that's going to make the stock market and yield reaction a lot different than it would have been in the prior cycle.
Now, over the last month, particularly, the acceleration of momentum in the Mag 7s really has been the clear leadership. And we've started to see divergent momentum in certain sectors, breadth of the market narrow. And obviously, these earnings are going to decide a lot. But you did a piece recently talking about, is it time for a change in leadership? Do you think that there's room for some of these beaten up sectors or these underperforming sectors to take over and start performing better as we move forward?
Yeah, absolutely. And not only that, I think things are just so stretched that your risk reward is almost so good that you just, why wouldn't you almost, right? We're in this market that right now seems to be a sort of perpetual motion machine driven by, tighter credit spreads and lower volatility. And the tech sector has really been leading that. But what's interesting is that in the period where inflation was beginning to rise, so, late 2020 and certainly through 2021, we did sort of have this realization that maybe you don't want to own these sort of high duration sectors like tech and consumer discretionary, and maybe you want to try and divest yourself of some duration. Therefore, sectors like energy and utilities started to do really well. And it kind of felt like it was destined to last longer. But it didn't really. It started to reverse in 2022, then really kind of hit the skids late 2022 when ChatGPT 3.5 was released, and really just everything's went into reverse since then. But if we are at the stage where, and certainly everything that I look at suggests that inflation is going to begin to reaccelerate this year. Now, that's not to say it's going to start making new highs or anything like that, but it's certainly going to diverge from what the market's expecting. And you can see what the market's expecting just by looking at CPI fixing swaps. And they currently, certainly for the US, but it's not dissimilar for Europe and the UK, etc., expect to see, headline CPI back down towards 2% within 12 months. But unfortunately, almost all inflation analysis tends to be backwards looking. But actually, if you look at forward-looking indicators, they're starting to inflect higher in several different kind of angles that show that, you're going to see higher inflation. So, I think not only is energy, beaten up, and tech is looking overbought in many measures, and it's also overowned. If you look at speculative positioning, it's extremely high right now. You have this inflation risk of coming back as well. So you're at the stage now, as I say, where you're almost like your risk reward is so good that you really want to think about rotating out some of these very overvalued stocks, and then looking at some of the undervalued ones with inflation and under ownership in your favor.
Well, you specifically referenced the energy markets, but a lot of the defensive bond proxy areas, obviously the high dividend yielding, whether it's the healthcares or utils and other sectors like this, is that the same opinion on those?
Yeah, very similar. I mean, the main, very interestingly, if you do look at, you can approximate the duration of each sector just by looking at the inverse of the dividend yield. And there's almost since, really since that late 2022, when you had that real, again, the chat GPT was the kind of like the proper catalyst, but really the trend had started back in July of that year, when the Fed had actually started hiking around then. And it was almost a perfect match between the highest duration sectors have performed the best, which was kind of the market's way of saying that we already don't think inflation's a problem, as in we think it's done, even though it was still high then, but the market was essentially saying we expect inflation to continue to fall and for it not to reaccelerate. So I think all these trends come out and reverse when you start to see inflation come back.
All right, so let's get to the slides that you have here. So we're going to start here on page 2. Now, you already referenced to it once, but why don't you explain to us your thoughts about the end of central bank independence?
So I think this is kind of really, for me, like a key theme. And it's, as I say, everything that's happening right now is related to inflation. You can go into the mechanics of why you think inflation, is in a more elevated regime. But a big part of that is fiscal spending. That most, or in fact, all of the high or hyperinflations you saw in the 20th century were preceded by central bank monetization of large government deficits. And we kind of basically had that sea change coming into, even before the pandemic, right? You already had sort of flirtation with kind of MMT-like policies. Central banks had been expanding their balance sheets for, most of the past 10 years, but we hadn't really seen any consumer inflation. We'd seen a lot of asset inflation. And really a big part of that was because governments were essentially not spending the money. Central banks were printing money, but the government, who is the spender of first resort, last resort, wasn't spending it. But that really started to change towards the end of the 2010s, and then really got turbocharged in the pandemic. But the first chart, I think, is really the way that kind of really elegantly kind of makes the point of how things have changed. And I've called this the Treasury put. In terms of the expectations, what people now have of their governments. Massively, it was already changing, but it massively expanded during the pandemic. So, what people expected their government to underwrite went from, my job in a recession to essentially, almost everything like, business solvency, consumption, even life itself when it came to COVID. So now you have like these persistently large government deficits, and you can see there that around about 2015, 16 it was. There's that deviation between the budget deficit and the unemployment rate. And really, it's just maintained that divergence since then. So really, we're in this different world of persistently large government deficits, and that is inherently inflationary. And I think that's why, even though we're in this cyclical decline in inflation right now, as far as secularly goes, longer term goes, we're in an elevated inflation regime. Inflation is likely to make a higher low, and then it's likely to start bouncing again. As I say, it doesn't even need to make a new high, but even if it goes back to, say, 4%, people are going to be worried it's maybe going to go to 5%. And that has real implications for markets, which are not really pricing in any of that at all.
All right, Simon, one of the big themes you have is the reacceleration of inflation. You mentioned it numerous times already. Here on page 3, we have the size and the composition of debt constraining the Fed. What's your thoughts on this?
So this really ties to the central bank independence. So kind of what I'm trying to show here really is that de facto the Fed is really already constrained by, first of all, by the size of the outstanding debt, because that means that interest payments are rising kind of stratospherically right now. They're very high. And that really kind of constrains the Fed's room for maneuverability. And the second thing is the average maturity of the debt is falling. Now, as probably your listeners are aware, have heard about, the Fed has been what I've called the Yellen pivot. Really, is at the beginning of last year, the Treasury switched to issuing mainly bills. So most of this large deficit over the last year or so has been funded using bills. That started to bring down the average maturity of the US debt. But the issue with short maturity profiles for a government is if the Fed comes out and wants to tighten policy, then that basically has an immediate impact on the fiscal. The cost of funding the government goes up almost immediately. So you create this fiscal squeeze, and essentially the Fed has to sort of re-loosen again because it creates this unintended fiscal squeeze. So you really don't want to have particularly short maturity debt overall. But that's kind of where we are. This bills are over 20% of the US debt. And when you basically don't have, a central bank that is using, with an inflation mandate, and you have a government that is less reined in, governments are inherently inflationary. That they want to, if most of the time, issue debt so they can spend money to please voters and get re-elected. So over history, governments tend to be inherently inflationary. So as you've got like a fiscal dominance, as they call it, that tends to be more likely part of an inflationary regime. Or you could actually flip it. Interestingly, it could be the other way around. It could be the last 30 years or so where we did have central bank independence was really only because we had structural low inflation anyway, through globalization, through demographics. And that basically allowed central banks to have independence. So really, maybe they didn't make much difference, at all. But whatever the reason is, we're now in a regime of elevated inflation, and in that regime, you don't really get central banks. They're able to operate with freedom like they normally do in most environments. You tend to get fiscal dominance, and that's really what we're shifting back to. And in that environment, it's more supportive of inflation. So that's another reason why the market is going to have to get used to persistently higher inflation, and really that's just not been priced into almost any market I look at yet.
So late last year, obviously, we had the Powell pivot, and the market was incredibly eager to pull forward the new rate cut cycle. And do you think the market is way too ambitious about when the rate cuts start?
I think it's very interesting because I couldn't honestly tell you why the Fed did pivot in December. There 1 minute they were saying they were data dependent. The data didn't change in any significant way. And then all of a sudden they were, backing the market. The market was already sort of quite dovishly pricing in like 3 cuts or so. And then it kind of, backed it up. And obviously the market just went to the races and carried on cutting. So I'm not 100%. My hypothesis is it's, again, going back to this lack of or blurring of fiscal and monetary policy now, which is one of the symptoms essentially of running a monetary system with a superabundance of reserves, which is basically what's happened since the great financial crisis. We've just got trillions of dollars of reserves, which really changes massively how fiscal and monetary work together. Right. So my hypothesis is really that, you have this massive interest bill. We know that the interest bill for this year for the Treasury is going to be huge. And on the current projection of where 10 years were, say when 10 years were up way above 4%, wherever they were in November, sort of December time, way above 4.5%, close maybe even to 5%. And then, you're looking at like interest rate bill in this year up to like the GDP of Spain. And obviously that's annualized, right? And all that's going to do is that's going to suck reserves out the system. It's going to either take the reserves out the system or it's going to reduce their velocity. Because, as much as the general belief is that interest gets paid back into the economy, so actually it's not problematic. That's not really what happens. It tends to, through a series of iterations, end up in the hands of people that have higher and higher propensity to save. So really you end up with high velocity reserves, like, from taxpayers essentially. And they end up going into, savers, essentially, funds, etc., who tend not to spend that interest. So I think it's highly liquidity draining from the system. And therefore, when the market maybe moved to start cutting or looking for an early cut in March. Maybe there's some sort of underlying kind of knowledge that, that's something that might start to become problematic. And therefore a cut, even though the Fed talks about, they sing from what they call a separation principle hymn sheet, which is that balance sheet policy and interest rate policy are separate. Really, in actuality, that's just not true, right? The BIS themselves have said it's something that's nice in theory, but just doesn't work in practice. And a cut would actually ameliorate some of the impacts of this liquidity. So the market's looking at QT, it's potentially looking at interest payments. It's certainly looking at the fact that everything's now a lot more crossed over than it used to be, which is why this quarterly refunding announcement for the Treasury this week has kind of got equal or higher billing than the Fed. And so that's part of the calculus, I think. It's not, people still talk about inflation and employment. These are sort of important, but I think they're now more second order. The thing that's really most important as far as markets are concerned and the Fed is concerned is liquidity. And because if liquidity suddenly drops sharply, then markets can fall into a spasm. And if that happens, you can end up very quickly one of these negative feedback loops that creates a recession, a feedback loop between markets and the economy. And that's really, what the Fed is trying to nip in the bud. And that's something they can have, very quick kind of effect on by cutting rates or by changing their balance sheet policy.
Just on that topic, I just wanted to ask about, obviously we've had a bit of a bull steepening with the twos, tens, and obviously famous investors like Stanley Druckenmiller have been very aggressive about betting on the 2-year bonds or notes in anticipation of obviously this rate cut cycle. Do you still think that a bull steepening is the most likely, and do you think we go back into the positives here?
Yeah, I think we are in a cycle for sure. I think we carry on steepening, and I think interestingly enough, if you look at where the composition of the Treasury debt, and when they have a higher proportion of bills, which they have now, obviously that's rising. It's over 20%, as I mentioned. That tends to lead to a steeper curve. Now, this is sort of controversial, I think, to some extent, but I think the reason is because the demand for bills is kind of elastic. So the more bills that are there offered, if you like, the market sort of takes them up without really much of a change in the yield. And then that reduces demand from the longer term part of the curve. So you actually end up with a steepening. Kind of, I guess it's more likely going to be slightly more of a bear steepening, which is kind of what we've seen over the last maybe 1 or 2 months or so. And I think, by the way, that's very important to watch, because when the quarterly refunding announcement, the last one in October, that kind of triggered the sell-off that we saw in bonds. And then that preceded, it wasn't long before, term premium had been rising. Powell started to talk about term premium. The curve was bear steepening. So I think that's something the Treasury will watch ahead of Wednesday's, how they're actually going to fund their deficit in the quarter in terms of what coupon sizes and note sizes. Because I think if they are worried about term premium or bear steepening, then that might discourage them from increasing the auction sizes by too much.
All right. Well, let's move on your slide deck. On page 4, you have some more charts in regard to the elevated inflation regime. So particularly here on the right-hand side, I was curious about the supply chain constraints coming back. Why don't you explain what you're seeing here?
Yeah, sure. I mean, I think inflation is, from as the slide says, from many different angles, one of which is supply chain constraints. Now, obviously, that you can see from the chart there, they were one of the big drivers of inflation in the first upwave, and then they've kind of collapsed in the interim period, but then they've started to rise again. And I think this is just, again, part of the new kind of environment we're in. In this environment of more geopolitical uncertainty, I think supply chains are going to be more brittle, more fragile. Most recently we've seen, of course, with the Red Sea, ships being routed around the Cape of Good Hope, adding, an extra 10 days or so onto journey times. The cost of tankers has, the leasing cost has doubled over the last 6 months. So, these things are obviously inflationary, And at the same time, the chart on the left makes the point that when you have large amounts of fiscal spending, pro-cyclical discretionary fiscal spending, which is what we've got, that's the blue line in the chart, that leads to structural rises in inflation as well. So you have like structural things working in the background that are very supportive of inflation. And then you have cyclical things, such as the supply chain constraints coming back that are also working. But there's two other important things as well, I think, when it comes to inflation that will be supportive, and that's profit margins. They were a big driver, again, of inflation. There was many companies that kind of rapidly rose their profit margins, probably in excess of their costs. I mean, they saw a situation, the biggest, if you like, disruption to supply and demand that's ever been seen. And given in the US, certainly, but it applies to Europe and the UK and other countries too, is that you have a lot of monopolies. So the largest companies were kind of able to raise prices the most under the cover of this massive supply and demand disruption. And although profit margins are not as high as they were, they're certainly still higher than they were at 2020. And okay, it's annual. That's what counts for. As you see, slide 5 there. One a big driver of profit margins is the fiscal deficit. You basically have this huge amount of government money essentially churning through the system, and there's an equation in economics called the Kalecki-Levy equation, which connects between the household sector, the corporate sector, the government sector, and the foreign sector. And essentially, when fiscal deficits rise, it tends, as you can see in the chart there, it tends to lead to a rise in profit margins. So it's kind of like we shouldn't sort of be surprised after this massive pro-cyclical fiscal deficit that we are seeing profit margins rising. And I think, as I say, even though they've dipped down over the last shorter period of time, they are primed to start rising again. And I think the risk is not so much a wage price spiral in this cycle, although leading indicators for wages are turning up as well. But I think we're going to be in a situation more like a profit wage price spiral, where profits rise, prices rise, that causes wages to rise, and then profits rise again. So I think the dynamics will be slightly different to what the 1970s, which was a wage price spiral. And as I say, all these things are working underneath the surface, that they weren't, maybe individually they were pointing to higher inflation or could point to higher inflation in the prior cycle. But because they weren't all happening at the same time, they didn't reinforce one another, and inflation was able to overall remain, around 2%. But now the cat's out the bag. All these price increases and signalings are all out of sync right now. And because they're out of sync, it makes it extremely hard for them to settle back down. Certainly for, at least, several years until we get anything like back to, the low inflation environment that the market has got used to.
All right, so let's move on, because one of the things you mentioned earlier in the interview was this concept of the stock market perpetual motion machine, and you're at this point suggesting it can't run forever. So when does it end?
I mean, if I could answer that question, I'd be in a lot easier spot. I wouldn't have so many slides, put it that way. I mean, look, what I like thermodynamics, the second law of thermodynamics says you can't have perpetual motion machines. So I guess all I can say is it can't run forever. But there's this really kind of sweet spot really for markets right now where you have, and again, this is linked to being in an elevated inflation regime, which we are now, but inflation right now is actually on the low side and falling. Is a sweet spot for the market. So on the one hand, you've essentially got low volatility, and low volatility is a direct feed into a lot of credit pricing models. So I think the low volatility is keeping credit spreads quite contained, is one of the reasons why you're seeing credit spreads quite contained. And then that obviously makes the market overall look good, because if people think that the credit situation is not maybe as bad as it maybe actually is. If you look at things like bankruptcy scores, that can help support the market. And at the other end of the equation, you've got low volatility is kind of feeding on itself, because you have, when you have rates high as you have today, you tend to get very high forward prices. So the chart on the right there, you can see that we're actually at this extreme. We're at the extreme of, like, in the last 25 years, we're at the highest kind of forward price versus the spot price and the lowest VIX. And so, we have this situation where, as I say, forward prices are high. What that does is that cheapen calls because options are priced off the forward price, not the spot price. That cheapens calls and it makes puts more expensive. And then because of the structure of the VIX and the way people tend to trade puts and calls in terms of how out of the money they are, that's repressing the VIX. So you have this higher rate environment, which is because ultimately of higher inflation, that's keeping the VIX very low. And that's then feeding into credit spreads. It's also repressing realized volatility. Implied volatility is persistently low, tends to keep realized volatility low. That makes the S&P sharp look very attractive, and that's supportive for prices as well. So you're in this, as I say, environment where it seems like the stock market can't lose. But I think any change to the inflation environment, if we did go back to a low and stable regime, which I don't expect, I think that would break that perpetual motion machine. And on the other hand, the same thing. I think if inflation started to reaccelerate, you would also have the same problem. So the stock market is kind of weaving a very sort of narrow aperture, like through the Panama Canal right now. But it wouldn't take much, I think, for that to change and for the market to look very different.
And do you think that the fact that we are in such a low vol regime, in such a sustained rally, that from a reflexive perspective, it opens the window for a lot more volatility when it does turn?
Yeah. I mean, that's how vol works. It gets repressed. People tend to get short it because it seems to only go down. But because it's already low, they have to sell even more to get the same return. So actually, on the surface, it looks like it's kind of calm, but it's like the analogy of a duck in the water. The feet are moving very rapidly. There's a lot going on under the surface. And then when things unravel, they unravel very quickly. That the Minskian, stability leading to instability is 100% what happens here.
All right. Well, let's wrap things up with one last question. On page 7, you have recession risks have receded for now. Obviously, when this kind of a rate hike cycle occurs, a lot of people inevitably believed it was going to lead to some sort of an economic contraction, and there was no sign of it. What are you seeing?
Well, I had to come at this, mea culpa, really, because I was definitely in the recession camp most of last year. And then it just became apparent that really it wasn't on the cards. It's not to say, I think one will happen, but it just became quite clear that it wasn't going to happen imminently. And the way I wanted to look at it's because I realized every time I wrote about recession, people say, well, we're in a recession. And maybe they'd be talking about, I don't know, manufacturing or talking about GDI. So I think you've got to be clear about your definitions. And I've always been happy with the NBER as an arbiter of recessions. It has some flaws in terms of they only tell you after the fact, but that's why you use leading indicators in your framework that lead the indicators that the NBER look at. But the chart on the left there shows you four of the main indicators that they look at to judge whether the economy is in recession. So you've got real personal consumption expenditures, non-farm payrolls, industrial production, and real personal income, less essentially government payments. And essentially every recession, these four have been contracting. Only one recession where it was 2001 where only one of them wasn't. So 3 or 4 of them are contracting. Now that's not, the NBR don't tell you explicitly how they judge whether it's a recession, but you can see there that that's in the past, that's basically been the case. And where are we today? If you zoom in that chart, and we look at the right-hand side, when I first looked at this, I think the orange one, which is industrial production, was sort of flirting with negative, and the red one, which is real personal income, was turning down a little bit. But you can see there now, like none of them are kind of, industrial production's inflected back up, and none of them look like they're very quickly going to go, contract soon. Now, obviously, one of the things about recessions, well, 2 things here. One, a lot of these data points are lagging. Second thing is they can be revised. And the third thing is when you hit a recession, it can happen, quite quickly.
Yeah.
But in terms of the NBR, us going into an NBR recession, it's looking unlikely it's something that can happen, say, in the next 3 to 6 months anyway, just given looking at these indicators. So I think for now it's something that, you can keep at bay. But I think as the year goes on, the higher interest rates will carry on biting. And that will have, an increasing effect. So maybe, ask me again, for instance, in June. I don't think we'll have been in a recession by then, but maybe things are starting to rapidly look very different. But as I say, for the next 3 to 6 months, I think it's something that really doesn't look imminent.
All right. Well, Simon, before I let you go, where can listeners find you?
So on Bloomberg, on the terminal, there's the Markets Live blog. So that basically has 24-hour, Monday to Friday coverage of markets with lots of different writers. And also have my column, which is called Macroscope, which you can also find on the terminal, and you can subscribe to that via the terminal.
Well, Simon, I can't thank you enough for joining us, and I look forward to having you back on the show in the future.
Thanks again for having me. Thanks, Patrick. Cheers.
Cheers. Well, thank you for tuning into the Market Huddle Plus. We'll be back next week for another episode. Cheers, everyone.